All right. Yeah, well, just today's a nice, excuse my French, bullshit type of day where we could talk some shop, share our opinions, how things may shake out tomorrow. And that's about it. I mean, there's nothing, there's a couple things I wanted to talk to you guys about, but there's no real way to handicap what's going on. But I definitely wanted to share a couple things with you guys and see what you guys thought of what's taking place. All right, let's get rolling. Let me make sure I got everything on mute. All right, so here's the story, right? And I'm sorry if I sound repetitive to those of you, obviously, who are members. I sound repetitive as it is to you guys when we get on this Tuesday webinar, and there are obviously people that aren't members. I gotta mention some things again because they'll be out in the dark. You know what I mean? So I apologize for coming across as repetitive again. But there's a reason why I tend to repeat myself a lot, especially in these times, because there are certain things that matter that we need to remind ourselves to pay attention to, right? Sometimes there's a lot of noise out there which can sway us in every different direction on a day-to-day basis, one day bullish, one day bearish. And we got to constantly remind ourselves of the backdrop and big picture wise, what's taking place. So it keeps us in line, right? So the way things were setting up coming into this week, actually rewind a couple weeks, because you guys can remember we spoke about it on this webinar. The setup in the market is an unusual one. And the reason I say that is we have, obviously, for the first time ever, the Fed is against us, not our friend, right? We've talked about that way too much. And I think right now it's the way we phrased it last week was, it's finally, everyone swallowed that pill. I think everybody has acknowledged now that basically the only way this can really come to an end is if the Fed stops rigging the game, right? In other words, tightening financial conditions and weighing on risk assets, okay, which is one of their tools, one of the few useful tools that they have to combat inflation, is to raise rates, drain liquidity, and weigh on risk assets, right? So the same thing they would do when they need to support the markets, the equity markets and risk assets, right? With money printing and everything else, they have an influence. So with inflation as hot as it is, hot as it's been, and pretty sticky, right? It doesn't really want to come in much outside of commodities recently. The Fed's really got to stay on course for the first time ever in our lifetimes, and can't worry about the economy in the sense of risk assets, right? They don't want to blow shit up, but they're okay. If you gave them the trade-off recession to defeat inflation, they take it in a heartbeat and run, right? So it's that simple. And I think that's the way we got to look at things and understand that, usually there's a Fed put, right? And you hear that term a lot, where the Fed would come to the rescue and support equity prices when they get a little too out of control on the downside, right? And right now, that's not a concern, a goal, or a worry of theirs, right? What's more important and what they feel can have a larger impact longer term is the threat of inflation getting out of hand, rather than a bear market that you may look at, a couple of years from now, right, and forget it even existed. So they have the blinders on, right? They have the blinkers, as we say in horse racing, to focus on one thing, and that's been inflation. Their only powerful tool is to tighten financial conditions, drain liquidity, right? The total opposite of what they've done throughout all these bull markets. And it really puts us in a nice pickle here, right? Because as much as some of these names that we've been looking at come down on a day-to-day, week-to-week basis, look appetizing and overdone to the downside, as much as We may see some bullish price action from time to time, or we're not seeing it, but maybe some bull flow from time to time. We got to remind ourselves that if nothing changes big picture wise, right? If the main focus and goal of the Fed is to focus on inflation and rig markets, then none of that matters. And I think a lot of us, not just us, but everybody fails to remember that and acknowledge that we may see some constructive signs out there today in the price action, or maybe Google and Microsoft survived earnings. Like this is what I get a kick out of. Everybody made this big thing about earnings this week for good reason. They're big names. Everybody's concerned about earnings, right? Because the economy's starting to weaken. And everybody's making a big thing like Microsoft and Google having good earnings can save the market, where in reality, it doesn't mean shit, right? It doesn't mean a damn thing if you think about it. As a matter of fact, us in general who want to get through this bear market and get closer to the end at some point, we would hope the numbers were awful. You know what I mean? God-forsaken awful. But Google and Microsoft surviving the quarter doesn't change not one damn thing to the current backdrop. Nothing, right? And on another point, and I wanted to share this with you guys and see what you felt. Because, again, I'm not a macro guy. And we've had this discussion in the steam room recently. The only time I have a tendency to look at these things, I follow it. I enjoy following it. But as far as being actionable, they never really made me any money. The only thing from time to time they've done is prevent me from losing money when we get into these type of environments. But I enjoy following it, okay? But the only time you'll hear me talking about this stuff as much as I am right now is when we get into these climates, right? So it's a good measuring stick. If I'm talking macro, there's a good chance the environment for long equities, macro Jesus is here, right? A couple of my split personalities. The backdrop is probably a hot mess for risk on, right? So you need to pay attention to it. You need to know what's going on. Otherwise, you need to sidestep it, move to the sidelines, and wait for the environment to change. There's no other way. You battling, right? Us bumping our heads up against the wall, which is the Fed right now, would have cost us nothing but money, right? Buying dips and pretending like they're not rigging the game. I mean, it's a no-win situation. But here's what I wanted to share with you guys. Stephen, you too especially, right? Maybe I'm missing something here. With Walmart and all these companies, right, as far as the corporate world's concerned, right? So we're talking about companies, stocks, they're coming out with warnings, margins, guidance, the whole 9 yards, right? If I'm not mistaken, the reason why Walmart and every other company of recent, what was the other one, the retail name that just flat out told it like it is, was one of the first to say, listen, it's shit. Not Target, the other guy who's RH, right? RH. Wasn't it RH, right? The good CEO, no? So if I'm not mistaken, correct me if I'm wrong, because you guys know me. There's no arrogance here. I could be 100% wrong. Isn't it inflation what's having an impact on these companies right now? Isn't it the inflationary pressures along with, everything that's been going on as far as the ports are concerned and all stuff like that, that's had an impact on like a Walmart and RH and all the rest of these companies that are running into a little bit of tough time? It's not, in other words, consequences from what the Fed is doing right now, which is draining liquidity, raising rates, tightening financial conditions, which would be the total opposite. Now, again, you're going to have even more headaches, right? So in other words, what I'm getting at is we're hearing, right, like inventory builds and all this stuff. So what we've been hearing recently from a lot of these companies that, the consumer out there, right, because things have got pricey in certain items that got pricey. They're setting priorities for the first time in their lives, right? So they'll buy food over buying clothes, the degenerates we are, right? So like somebody just mentioned it, I think Ed, it went by me so quick. We haven't seen anything. When they lose a job, what do you think is going to happen? So the reason I bring this up is people are looking at some of these warnings and concerns out of these companies right now as, oh shit, the Fed has to hit the brakes because we're already seeing it in some of these numbers. What they're missing is, no, if anything, it's the total opposite. Inflationary pressures are having an impact on these companies and their margins and consumer behavior. And if anything, the Fed has to stay even more on course to combat inflation. You understand what I'm getting at? So what they think is something that potentially can sway the Fed and get that pivot that they want, I think they're being misled because we're not seeing any of the impact as far as what we look at consequences from the Fed doing what they're doing right now. And that's aggressively tightening conditions and raising rates. Okay, when we see that impact, that's when you see the people lose their jobs. That's when you see deflationary pressures, right? That's when you see things come down in price, but people still aren't buying because they don't have an income, right? So they're definitely their concerns. They're just as important, but it's going to be a whole different ball game. And I just think a lot of people are being misled, thinking, all right, there's enough damage here from the Fed raising rates. They're probably going to stop. They still haven't taken down inflation yet, right? And I think we're starting to see right now that a lot of corporate America, it's having an impact, even on some of the bigger companies out there, which initially people thought might be able to dodge that inflation bullet and raise prices as long as the consumer was healthy enough, right? So again, I don't want to get too macro on you, but I think and I could be wrong, right? Something's very strange out there is what I'm getting at, okay? They're already pricing in rate cuts, okay? They're already pricing in rate cuts for next year, the market, okay? And if the Fed is still determined and still has the blinkers on to take down inflation, what they're going to need to do tomorrow is they're going to need to come out as hawkish as hell, right? And get the market to believe and force the market to believe that they're not budgeting. Rate cuts are in the picture, and their total focus is on inflation, right? Because right now what we've seen rates come in, we've seen rate cuts being already priced in for next year. And again, the only reason I'm saying that is the Fed probably, again, unless I'm missing something here, which is certainly a possibility, but the Fed is nowhere near rate cuts right now. You know what I mean? Nowhere near that big Fed put that everyone wants. Now, maybe they're closer to a Fed pause that a lot of people, right? Okay, so there's an example, well-timed, X-Trader. So you see core inflation is coming down, right? The Fed is not cutting rates into that, right? For the Fed to cut rates into core inflation flashing a 6 handle, you know what I mean? That's not going to happen. Why? Because what do you think? What do you think the impact is going to have? What kind of impact do you think they're going to have if they start cutting rates when inflation's still elevated and people still have jobs and still have money? They'll just inflate the bubble again, and inflation will fly off the hinges. You understand? And if you've been paying attention to what Powell's what he's been talking about specifically for several times now, the one thing they want to try to avoid is the mistake of the 70s, right? They supposedly learned from that mistake. The mistake of the 70s was they stopped tightening too early. Okay. So for them, in other words, inflation started to flare up again, and then they had to come back and do more, which was a disaster. So Powell mentioned that one of his main goals here is to stay the course. And in simple terms, so we understand what he's doing, is rig the game until inflation is dead and buried kaput. Okay? Because they know they have the tools for deflation. They know they have the tools for a potential recession or the great financial crisis, right? Trial and error. They've been down that road before. They know they can implement QE and it's worked. Okay. Inflation, they don't have the same tools. They don't have the same tools to play those type of games. So again, from what we're hearing from the Fed, and a lot of people have interpreted it this way. I'm not the only one out there who's interpreted it this way. But I just think that a lot of people are taking a little bit of weakness in the economy and earnings guidance and stuff like that that we're seeing as some, some big slowdown out there that's going to scare the Fed from doing what they're doing, unless there's something behind the scenes that I don't know about. I just don't see it. I just don't see it right now. I don't see it. Right. So there's a lot in between all that. You don't have to get to the Fed cutting rates to find a floor in the market, right? If the Fed pauses, right, you could find some sort of floor, right? So an intermediate low, like we've been talking about, and the market finds some sort of little mini uptrend for a couple of months before things get dicey again when the economy really starts to slow down. But as far as a major bottom off the Fed, it's not even in the picture. Like for me, it's not even in the picture. Can there be a bottom without the Fed cutting rates? Possible. If you look back through history, not likely. Okay. And I shouldn't say that. We may find a low, but in all likelihood, for the market to really find that mojo again, as far as a bullish trend, it's usually an accommodating Fed that enters the picture. Eventually that enters the picture. And I told you guys last week, the Fed, I've seen the market get absolutely destroyed into Fed rate cuts as they happened. Because when the Fed is cutting rates, they're cutting rates for a reason, and that's because things are falling apart at the seams all around them. You understand? And it's too ugly to ignore. And what people do is they don't put any credence into those rate cuts even working because it's not immediate. Same thing like now. The Fed is raising rates. You don't see immediate impact. You see it 2 quarters from now. So when the Fed's cutting rates, a lot of investors, that's their mentality. They're saying, well, this is not changing anything right now. And the economy, the wheels are coming off. So a lot of times you see the most vicious sell-offs occur as the Fed is cutting rates. So these are just things that get from prior experience going through cycles like this that I remember. And it's going to be interesting to see how all this plays out, right? So tomorrow, the reason why I wanted to talk about that initially is tomorrow we have the Fed, okay? And if the Fed does what they've been doing and they come out as hawkish as we ever heard them sound, right? And I think it's a really highly likely possibility that they're going to do that. It's going to be really interesting to see how this market reacts with the VIX near the lower end of the range, coming off a rally. It's going to be interesting. But it's 1 or 2 days of selling, and that could all change. All right, so that being said, right, I wanted to start off with the Fed, not because I like talking about the Fed, but just because we have the Fed tomorrow, and that's the glass half empty view on my end, right? The glass half full version, the positive version of what I'm seeing right now is that a lot of players, a lot of professionals okay, a lot of the professional money out there sees what I'm talking about and is positioned accordingly, and has been the process of them positioning and de-risking has been going on for a bit now. It's nothing new. Like, we've been talking about this, right? We're not any smarter than anybody else who's in this business, right? We're all in the same bucket. Everybody on the professional side has very little exposure to equities right now. Very little exposure to equities. So what that tells us is that unless something really goes boom, right? Unless something really breaks, the odds of a sell-off really snowballing into anything bigger than, a couple day pull that we can try to get long of, the odds of that are low, right? Now, can something go boom? Of course it can. And that's a real risk when you get into this environment. The Fed has been known for breaking shit, right? Credit markets have been known to freeze up when the Fed does things like this. So, the probability of something breaking obviously is a lot higher than we would like. But what I'm getting at is I think we still could be opportunistic and look for trades. Okay, trades. Again, I hate telling anybody time frames because everybody is, everybody's so different from everybody else, right? Like, a lot of us have been trading intraday. You may not have the tools or time or anything to trade intraday. So I'm not going to force you into trading intraday, right? I'm not going to, in other words, I'm not going to present it like it's the only thing you can do. What you can do if you can't trade intraday is you look for those rounds of selling, right? So in other words, we get some selling tomorrow and look for opportunities off that for those snapback rallies, okay? The other thing too, which we can look for as far as opportunities in this mess with all this noise going on, is action in individual names. Now, it's a little tricky now this week and next week because you have every big name reporting earnings, right? So like today is a perfect example. I think MGR mentioned that Susie came on here or whoever it was. The flow was a disaster today. I mean, how could it not be a disaster? If we were in a bull market, we would have seen Google and Microsoft catch call sweeper activity every second throughout the hour, throughout the day, right? We've been down that road. When we're in a bull market, Microsoft would have caught 1,000 call sweeps by the closing bell today. Today, the flow leaned bearish and had a mix to it. You don't understand. These players always lean bullish in these names. For these names to catch the type, yeah, exactly, with such seesaw action today. These names, for them to catch straight put action without any call buying around earnings is really unlikely. Like, today's action in Microsoft and Google is pretty much as bearish as you're going to see it. It's as protective as you're going to see it. That's what it looks like. When things are good, you don't see, there's not a put buy to be found. So what I'm getting at is the flow was a mess today. Likely there will be more days that it's messy than not, probably into next week. And then once we get through next week, and that's where most of the big names are done. You still have earnings, but most of the bigger names are done. And the name of companies that have already reported grows larger, right? So you can look at actions toward that. I think we're going to see more opportunities, both on the long and short side, in individual names. All right. And like we were talking about last week, if nothing breaks and we find a way to hold this range, hold the lows, right? And there are rallies in between. And then when we get, like just recently, when we rally for a week and, we get a little too stretched over a short period of time, those of you who like to play the downside can look for tactical opportunities on the downside. But I think my job here on a weekly basis is to remind you guys that erase from your memory the market we've been a part of the last decade. You have to erase that from your memory, okay? If we happen to go through shorter periods, days, weeks, where the market resembles that type of price action, which is possible, okay? I'm talking about days and weeks, okay? That's great, all right? It'll be a lot of fun. We'll probably be pissed off that we sold things too early because we're not looking for that type of price action, but it doesn't matter. There'll be a ton of opportunities if the market is as smooth as it was back then, right? But the missing link, okay, is you don't have the faucets running right now. Meaning you don't have liquidity getting poured into this market, okay? As a matter of fact, you have the total opposite at the most aggressive and fastest pace throughout the world. I'm not just talking about just the Fed, right? With the ECB and everywhere else across the globe outside of China, you have the most aggressive tightening cycle that we've ever seen in our lifetime. So the type of price action and speculative just nature to buying that we saw over the past, especially over the last few years, you have to get that out of your head and erase it from your memory until Mr. Powell and the Fed get their asses back on our side. Okay? So we don't want to erase it completely. We want to be able to get access to it again, because the likelihood is the Fed will be back on our side. Okay, I can almost guarantee it, and you can't guarantee too much in this game. Right? It's only a matter of time. But for the right now, especially the right now, we got to get it through. We got to get it out of our heads, right? And I'll just give you an example. Like we had a rally here recently, which is really not much, right? You had a nice little uptrend, believe it or not, from the lows there. The majority of you guys, and this is not a knock, especially the newer guys out there, you guys wouldn't even call this a bounce. You guys would, call this down to flattish, okay? But these are the type of things you need to try to look for and make some money in between as we go through this, okay? Because you need a specific catalyst, right? The main catalyst is what I just told you. The Fed has the faucets are running. Nothing matters. Fundamentals don't matter. Who brought them public don't matter. Nothing matters when the Fed is printing money. Yeah, you want to see? All right, maybe a chart will get the point across. Wait, what happened to my? Oh, here it is. Okay, let's look at this a second here. Maybe this will get the point across to you guys. I posted today on my Twitter so you guys can see. Oh, all right. Let me open the chat so I hear who's talking. Okay, this is M1 growth, right? The spike off COVID, right, from the printing press firing off the Fed into COVID, okay, to save the global economy, if you ask me. It's not even on the chart. You understand? It's literally off the chart of how much money printing and easing and the velocity of money that was out there off the Fed's actions into the COVID lows. Okay, it's up in this vicinity somewhere. Okay, look at what's going on here. You see where we're at right now? So all of that that came in has come out, and we're still in the process of going lower here. We're still in the process of it being drained. Okay, so obviously the flow, especially, guys, you guys heard me, those of you in the steam room or even on Twitter, the amount of flow that we saw off the COVID lows, right? Bullshit names, dollar stocks, dollar weed stocks that were seeing 100,000 calls bought on a line. Okay, what was that dollar weed stock that traded with Decron and the other piece of garbage, CGC? You remember those guys? There was a trio. There was another one that traded under $1 that traded volume that Tilray. No, not Tilray. No. SNDL. Thank you, Ed. SNDL. And Hexa was another one. You know, these are names, guys, they would never see that anything remotely close to that call buying. You know, they traded 1,000 contracts a day. Now we would see day after day that SNDL had 100,000 calls traded on one line. Absurd. Or days where Neo, right, had over 100,000 calls on one line. So the amount of call activity that was generated, the flow off that, you know, off the kitchen sink being thrown in from the Fed, the money printing and liquidity being poured in between fiscal and the Fed, you know, was absurd. Absurd. So you can't expect that anytime soon here. You can't expect what we were seeing, the way stocks were behaving anytime soon, especially when the total opposite. SNDL is going to split 6 different times MGR and still go to zero. Exactly. But I know most of you are aware of this. I'm just trying to get the point, of course. You know, I mean, you look at charts. We look at charts every day, right? The Eiffel Tower, every single one of these, you have the same pattern. It was make believe. Aaron had the best quote. I think it was yesterday. He said, you know, he was more taken back by the run up and the price action and the flow in these names when they were going up. Forget about going down. That's where these things belong, is at zero. The run up and the call buying they caught on the way up was jaw dropping, mind boggling. Right? So when we do get to a better period, and I think a lot of us who have been in the game, I'm not going to say we're going to enjoy it more, but we're going to feel like our experience and what we've learned and our edge is worth more to what we're going into eventually. In other words, when we do find a bottom, okay, and the market finds some stability and you don't have to worry about crash risk every other day, you know, credit markets freezing up or stuff like that. When we find that type of low, we can be stock pickers again. The stuff we were taught over the years and learned that were useless over the last 2 years, we can use that stuff again. You know, the edge matters again. And in reality, the last 2 years, the edge didn't really matter. You could have thrown a dart a lot of the time, especially the first half of that bull market, and made money. So I just think we're getting, when we get into a better climate is the best way to put it. When we do get into that better climate, I think we still need to be smart about things to make money. You know, the entries are going to matter. Taking profits rather than getting greedy every single time is going to matter, is going to have an impact. Again, the past 2 years, it didn't matter. You were an ass if you took profit, because you were an idiot every time you took profit, it felt like, right? Because the stock went higher every single time. So now, you know, we're going to get back into a time where stock picking matters, you know, taking profit, being smart about things matter. It's not the worst thing. It's not the worst thing. It's actually a good thing. It's just, it's tougher times. We got to get to that point. That's the point we got to get to. Forget that snapback rally led by crap going to new highs. We need the Fed for that to happen. You need the Fed. It's not going to happen without the Fed. It's not going to happen. So here's like another example. Again, I know a lot of you guys, you know, you don't want to look at this shit, but I mean, this is stuff you got to look at now, in my opinion, to at least have an idea of where they are at. So you can, okay, let me show you and I can explain it better. And you guys, I know a lot of you guys, what am I thinking? I'll look at this anyway. All right. So you see this, right? These are the credit default swaps, the chart of it from Sentiment Trader we look at, right? And, we talked about this chart a lot, right? It's literally a mirror image, the inverse of what the SPX has done. Okay, when this thing is higher, SPX lower. When this thing goes lower, SPX higher, literally. Okay, almost to the day. So when you see credit default swaps come in over the course of a couple of days, right, during this time, okay, in bull markets, and when we get to a better environment, it may not matter. But when we see credit default swaps come in, I don't know what day this is, but they come down for a couple of days. What the Fed cannot allow to happen, okay, is this. They cannot allow that to happen. Okay. What they are doing, part of one of their tools for tightening financial conditions, is this uptrend. Literally, that's one of their tools to tightening financial conditions. Okay. Spreads widening out. So when this comes in for a couple of days off a rally like it did here, right? We got to be mindful. We got to be aware of, all right, listen, the odds are this thing is not going to come in much further. They're not going to allow that to happen. So we got to be careful for some sort of pop and wash. That means a wash in the equity prices, right? And then if we're interested in playing something on the long side or playing long intraday, whatever the case may be, then we can look towards that. You know what I mean? Again, it's just being mindful of the stuff that's going on right now. Now, you could say, listen, Jesus, I got a headache. I don't want to. If you don't want to know where this stuff is, if you don't want to look at this stuff, you have to move to the sidelines. Okay? Because it matters. It's not a coincidence, guys, that this has done this. It's no coincidence. No coincidence. You know what I mean? Another chart, shoot, I don't know how I did it, but the financial conditions index, you could get that from Bloomberg. You could get that from Goldman, right? So, what am I doing? I'm the worst with this shit. There's probably a million things. I mentioned this thing 100 times. I could pull it up on TradingView, but the other charts are a lot better. So, and this is stuff like we've been talking about in this team, right? So just to give you a general idea, okay? This is a measure of financial conditions tightening and loosening, right? So here, financial conditions top out, right? They come in, hence a rally. Here, financial conditions bottom out, start to tighten, right? The market rolls over. Okay. Here, financial conditions top out, start to loosen, a rally. You know what I mean? Now, in a bull market, you see this? You take this and flush it down the toilet bowl. You don't look at it once. Hold on, I gotta put the air on. I'm dying to heat. You don't look at it once during a bull market. You be staring at grass, bro. Right? In a bull market, you'd be staring at paint dry if you're looking at this stuff. But in this right now, in the market we're in, especially with all the programs and algos, they're the only ones playing right now. This is the only stuff. This is the only stuff that matters in reality. It's the only stuff that matters. It's the only stuff that's worth paying attention to, my opinion. And, you guys who follow it know exactly what I'm talking about. Where's that financial, Where's that one chart I posted today? I can't take it. Let me go. I think it may be on here. Just one more thing on this, and then I'll drop it. We'll talk about something else. Where is it? It's over here, probably. I think I posted on regular Twitter. Here, okay, a smaller version, right? So this is what I was referring to. This is the financial conditions index, right? Like I said, there's a few of them. There's the Bloomberg one, Goldman one is a popular one. Chicago Fed, TD has a good one, right? Here, they're all here, okay? When they're rising, the Fed is tightening financial conditions. They're rigging the game to the downside. When they're loosening things, making it easy, making money easier, right? Hence easy, they're rigging the game to the upside, all right? Now you see this, they've been tightening. This is what the Fed's been doing to combat inflation, okay? Every time we get some sort of bear market rally, right? And spreads tighten up and all the stuff that goes into tightening financial conditions off a rally is going to start loosening up. It's going to start getting easier, okay? And come down. The Fed to even try to tame inflation has to keep financial conditions tight. Has to, right? So why have these bear markets, these rallies fall on their face every time, right? Every time they're at a point where they can see some decent follow through and some momentum to the upside, they stop on a dime because the Fed can't allow it here. They can't allow it here. It's not worth the risk to them. Now, you know, there are conspiracy theories out there right now that the Fed is playing both sides somehow, right? They're putting a bid in there. You guys have heard it, no? With the, you know, because the Fed balance sheet. Listen, I'm not a balance sheet guy. I don't know how it works, but there's been bumps along the way. But you know, it's not that far-fetched that every time the market and the economy looks like the wheels are coming off, that the Fed has to try to do something so something doesn't blow up. And then the market finds its footing, its rally. People forget about it so quick. And then they gotta do the other side to combat inflation. And I honestly think their words, okay, I don't know about any conspiracy theory behind the scenes stuff as far as the downside is concerned, but their words alone, in other words, the Fed speak, them talking and speeches and what they're saying does it. All right. So let's see. Tomorrow's going to be. I'm really interested to see how this shakes out tomorrow, because I think unless I'm missing something, and I'm going to find out tomorrow, and I'll be the first to admit it to you guys. Unless I'm missing something, they really need to be as hawkish as all hell. I don't see how they can afford not to be extremely hawkish. If they even present the slightest thought that a Fed pause may be in the works, I think everything they've done goes to shit. And you hear everybody talk, right? The Fed loses credibility. That's what they risk. That's what they risk. No, burn Sharpies. That would help Sharpies. Oh. Yeah. I don't see, because my opinion, right, for Sharpies, and again, I could be wrong, only time will tell. This week is going to be a big update. But what GD is referring to is commercial hedgers, okay? What I think commercial hedgers are positioned for is what we talked about on the positioning side, okay? Everybody had played the other side, okay? But you got to understand, that didn't start GD here. That started literally into these lows here. You know what I mean? Into these lows. So I think what the commercial hedgers, what their outlook is, everybody is on the other side now. they're betting on downside, they're net short, and they're positioned for these lows holding and possibly some sort of bear market rally, which again, you guys think, a lot of you guys don't think it's happened already. Guys, this is a bear market rally. You don't believe me? Get short into the lows or talk to somebody who's short into the lows here, and they'll tell you this rally's been killing them. You know what I mean? So the Sharpies, the sharp money, quote unquote, as we refer to them, they got net long, right, into this yank. And they've remained that way. They've remained that way. This week is going to be interesting, GD, because now this week, Friday's update, we see this rally and we see if they trimmed any there. I think that's going to be telling for us to whether this has more to go, not even just upside time-wise, or they're concerned that, you know, it might get a little dicey first. So, you know, based off positioning, and it's still over there, guys, something has to go boom for this thing to roll over and bust the lows here. You know, anything's possible in this type of environment. But again, no crystal ball. The logic is there's just nobody long, okay? There's nobody long. And not only that, they went net short here. Remember we were talking about it? Hedge funds for the first time, they dipped their beat net short. You know, they were kind of neutral for a while, right? They wouldn't go long, they wouldn't go short. They were confused like the most of us. And they went and got net short into these lows. So the reasoning for that, the reasoning why these lows should hold and you should see rallies off weakness. So kind of like this, right? Because those players who are short and have been sitting through a lot of this, when they get a little move lower for a couple days, they look to cover. You know what I mean? So they look to cover into weakness, and then if they get a snapback rally, they can add those shorts back on. So you kind of got shorts like playing against themselves right now in a sense. And it makes for like a choppy type environment. Kind of this is exactly what we're seeing here. You know, exactly what we're seeing. So for us, let's say for us looking for, if you're bullish, right, you want a long entry, what you want to see one more off the Fed at least tomorrow, or even ahead of the Fed, it doesn't matter. But you want to see another day of some weakness, and then you could start looking, right? And then, you know, you're looking for something kind of like that again. That type of thing. Alan, that's another great question. You know, you got it's in a midterm year, right? Election year. What do you think they're more concerned about? Probably inflation right now, but I guarantee you that's going to change, you know? But I think right now, if you're worried about like the administration, what kind of effect and influence they may have, I think they're more concerned about inflation than anything else. You know? And listen, I don't have a Fed fetish. You guys know I'm not a Fed basher. I don't tout the Fed. It is what it is, right? I'm a realist. For what has gone on, we've talked about this, right, Lulu? Right now, to this point, the Fed would take this all day long, what's gone on here. You realize that, right? Right? The Fed, exactly what's gone on in the market, in speculative pockets, the price action, in the indices, you name it. The Fed right now has got their finger crossed that this continues. They couldn't draw it up any better the way it's played out till now. Okay. The problem is history is against them. Usually it can start off this way, but usually somebody goes through the windshield, right? As we say, it's inevitable. It's going to happen. Right now, a couple of crypto firms going through the windshield. The Fed is as happy as a pig in shit with how this has been playing out. Which funds are we talking about, Troy? There's nobody long. There's nobody long. There's nobody long. Hedge funds, nobody long. I'll give you an example, and you could call me nuts, but actually a lot of you guys agreed with me. The BOVA fund manager survey that came out, right? When was that? Holy shit, when was that? Last week, right? That was last week. I think it set off that rally on that day because of how bearishly positioned. I mean, they were suicidal. Fund managers were suicidal off that survey. Highest cash, so bad is good, right? Exactly. That was the title of it. Highest cash since Lehman. Crazy numbers. I forgot least amount of equity exposure since like 2002. Bottom type readings. All kidding aside, bottom type readings. If you didn't have inflation, we'd be talking a different tune right now, guys. We'd be talking bottom, no questions asked, bottom. Honestly, even with fund flows, we'd be talking bottom if the Fed wasn't rigging the game. Even with fund flows, still they haven't capitulated. I still would be talking bottom because I think we'd get a bear market rally worth it to not even worry about what's going to happen 6 months, a year from now. You know what I mean? The problem now, Troy, here's the problem, okay? Even with positioning the way it is, if we can make the case that these lows are going to hold, okay, you got better odds of these lows holding here, no doubt, based on positioning, okay? The problem is, what's your upside? Tell me your upside. How do you measure your upside so you can gauge your risk reward and see if a trade's worth it? Where's your upside? What about if this here, right, is where the Fed is not allowing any more upside, right? What about if that's where they aggressively tighten conditions? What do? That's your upside, all right? If you know that for a fact, then, right, we can place some decent bets. Bottom of the range, we could get long, right? And we can sell into a rally. We're not going to wait for exactly this because the rallies might not get there. So we'll sell into this every time if we know that. Okay. But you see how that skewed your risk reward all of a sudden, right? Okay. Without the Fed rigging the game, this is not your upside. You have upside until they squeeze everybody who's short and has no position equities. You wait to CTAs get net long before you sell. You wait for hedge funds to get net long before you sell. You understand? But you can't do that now. You can't do that now because now you got the Fed against you. Yeah, but that's it, Bays. You know what I mean? We don't know. I'm being honest. I have no idea. Like, you know, a lot of you look at Fibonacci extensions or resistance levels, technicals. A lot of things work. Okay, again, not all the time, but you can get a measure of upside. There are things that work, so you can get a ballpark and you can evaluate and say, all right, this is my risk reward. It's worth taking a shot. Or how much should I take a shot of this risk reward? You can't do that now. That's the main problem. You understand? Jay, those are things to look for change, not the place to do business. Hey, say it again, Jay. Oh, this is Ron Cheryl. This is probably a little snack at me here. Jay, those are things to look for change, not the place to do business. Well, it's past 4 o'clock. Reword it, because I don't know what the hell you're talking about. Oh. I thought you're cracking a wisecrack joke. No, but I know. I'm not saying, you know, I don't know fibs from Liberace to Fibonacci. I have no clue. What I'm saying is we all have stuff that we can measure risk reward with when a trade sets up. That's the point I'm trying to make. Everybody has different things they look at. Right? That's the point I'm trying to make. Not specifically Liberace's, you know. My point now is that the upside here, even though you think something you're looking at may work again, the likelihood is it doesn't, because the Fed is rigging the game. The Fed is rigging the game. You know what I mean? The Fed is rigging the game. Here, stopped on a dime, right? And then boop. I mean, this over here, and this is where I got long. You guys remember my SPY calls off Sharpies into this rally, okay? Of this rally here, okay? The Fed, they did everything in their power to knock this shit down. I didn't think the Fed was going to do what they're doing right now, being dead straight. I didn't think they had to keep coconuts to rig the game and roll the dice with the economy, you know? They did. So that's why we're over here now. You know what I mean? But that's the problem. That's the main problem. Again, we can still find areas to play. I think right now that's how we got to look at it, is that if you're looking at any long opportunities for overnight trades, you know what I mean? You're playing off this low or this area, and the upside, I guess maybe you used it. It doesn't have to be this, but I don't know what he used, you know? Hartnett from Bova, right? He says 4,200 tippy top. That's where you short, right? That's where he thinks you short. You can put a short on if you get up that high. The problem getting up that high, I think there are a lot of bears that want to short that. The market's going to give it to them. I don't know. Maybe because they're short now. Maybe. I don't know. It's tricky. And for those of you who you know, don't know what the hell I'm talking about, talk about this in regards to positioning, right? So just so you guys get an idea, it's not make-believe stuff. Like, again, if the Fed is not reading the game, you guys know the majority of us are all over this right now. All over this. I know I am all over this, even though there's not a sweep that I can buy yet, but I'd be all over it. What am I looking for? Oh. Okay, so here are hedge fund exposure, net exposure, not just one hedge fund in particular, the average, the whole ball of wax, right? Here's the zero line, right? You see this? Puke to a low, boom. For whatever reason, they didn't want to go there. They finally went there. On top of everything else, right? CTAs, systematic funds, risk parity funds, futures positioning. Have you seen that? Oh my God. Talk about lopsided. Everything looks the same. So here, into this low, for whatever reason, they took the dive and got net short, right? They could get a lot more short than this. I've seen them a lot more short than this. But with everything else, there was a high probability that they would get squeezed, right? So they got squeezed now a little bit. But you can see, I think this is actually back down here now. It's not even cover much. So this is all still, let me show you some other stuff here. Hold on. Let's see, will this pull it up here? Right here, look at this. Okay. You see this? This is why I think, who asked that before? GD, I forget, you guys have your initials on here, about Sharpies. This is why I think Sharpies got net long here and were aggressive. This is aggregate US equity futures position. Look. Okay. Even more net short than they were into the COVID lows. No, well, COVID lows happened so damn fast. You know, Here's another one here. Look, asset managers and levered funds. You know, here's all the index futures. They're net short all of them. By the way, the S&P 500, they weren't even net short. That was the last one of the bunch. They finally dipped their beak net short there. You know, it's all over the place, all over here. I think, honestly, I think this was the catalyst for a big piece of this rally here, you know? And you know how the noise out there, the media, whatever, they can portray positive stories out of dog shit if the price action is going higher. You know what I mean? Like nothing's changed. What's changed? Commodities rolled over maybe, but the market was selling off even before that when commodities were rolling over. Here's Sharpies. So this is commercial hedgers, right? This is up to date. And here's the zero line. So this is good, considered this, you know, the smarter money out there. They usually hedge. They don't really put on too much risk. But a lot of times they take the other side when flow positioning is as lopsided as it is right now. And that's it. So that's the setup. The risk, right? The risk if something breaks is what we talk about constantly. Come on. Oh, here we go again. I had trouble with this Sunday, right? Let me see. Oh, here it is. So the risk if the Fed breaks something, okay, the players who are short are going to end up getting paid, right? If the market goes down, if something freezes up in the credit markets, the hedge funds are going to get paid on their little net short position. Retail, the passive retail crowd, look at this disaster. So that would be, that's the risk. That's the risk. That's the risk. Now, can I tell you one more thing, and then I'll take questions, whatever. If you get rid of this, I think that's honestly the green light, aside from anything else from like flow or anything else we're looking at, that would be a green light in itself to start building positions. In other words, you may be early, there may be a little more downside, but risk reward wise, blow up image, right click on the image. On the image, I could do it on the image. Let me see. Right click on the image. You guys teach me something every day. Hold on. Right click. Oh, at the same time, simultaneously? Control plus minus. Let me see. How am I going to find the plus minus? Where the hell is the plus minus? Where's the plus minus on this freaking keyboard? Nah. Oh. Right click first. Do I hold it down? Oh, okay. And where the hell's the plus minus, for God's sake? Oh, open a new tab. Yeah. Ah, look at this. All right. See, you guys teach me something now. Someone teach me where the plus minus is. Where's the plus minus on the freaking keyboard? Could it be there's no? Oh, here it is. I got it. I got it. Oh, you guys are amazing. Look at you guys. Oh, the only problem is, how would I go down there? It's going to be all one. Oh, press and hold. Oh, hold on. Wait. Oh, look at this. Look at you guys, huh? You guys are amazing. See, that's why I come to these Tuesday webinars. That's why I come. I don't know about you guys. Hold on a second. Oh, wrong button. Wait, now I'm holding too many buttons at once here. What the hell am I doing? All right, before I break something, you guys are throwing out too many commands. Slow it down. Slow it down. All right, so this blue line is just, again, you guys know, we've been talking about this forever. All right. So if you want to go, let's go off like statistics, history, right? Used experience and shit may come in handy sometimes. The V-shaped bottoms, not even V-shaped, U-shaped bottoms. So in other words, new high potential, right? New highs. You got to have one or two things, and most of the time it's both. The Fed, accommodating Fed, and Fed flow capitulation, fund flow capitulation. Yeah, if you get fund flow capitulation, Boz, then you could come to the conclusion that the downside is worth the upside. Let me try to rephrase that. The risk reward becomes extremely favorable. Does that make sense? Every V-shaped recovery, Bays, is it Bays or Boz? Yeah, you just spelled it the way I see it again. How's that help me? 1 for Boz, 2 for Bays. Bays, okay. So every V-shaped recovery, okay? And what I call those V-shaped, I refer to them as corrections, no matter how harsh they are. Even though they, like COVID was beyond a correction, but it was so fast, to me, it was a correction. But every V-shaped recovery that led to new highs, okay, had fund flows capitulate. Everyone that didn't, there were 2 of them. It was 2000 and the tech bubble and 2008. And they led to bear markets. You know what I mean? They were extended because you didn't get that capitulation. Like, people are making the argument for capitulation now, and they're not wrong. There's been some capitulation out there, especially in the bond market. There's been capitulation, you know. But in the equity market, you can't make the argument that there's been capitulation with fund flow bull flagging up here. You know what I mean? How could you make that? How could, this is not it. This is money market. How can you make the argument equity fund flow is here and there's been capitulation? And guys, that's what I tell you, the beauty of it, when it comes down, it doesn't go back for a long, long, long time. Hence the bull markets, the non-believers. Do you see what this did from January 2018 till January 2021? It went from small inflows to outflows. There wasn't even inflows. There weren't even inflows. And then they came in like a bat out of hell. Yeah, so in other words, what that tells us, that dips will be bought, you understand? And usually the final chapter of bull markets ends with this. They come in, and then the market crashes. Isn't that incredible? It waits for this, and then it crashes. When the music stops, not corrections. Corrections are a different story. Corrections can happen anywhere, but they come right back. But when the music stops, so a bull market going to a bear market, the final chapter of that bull market story almost always ends in this. They come late to the party, and they get caught. Fund flows are just the weekly inflows, passive flows into funds, equity funds. We're talking about here specifically. And what the hell point I was going to make? Oh, the final chapter of bear markets, from my recollection, again, I don't have the data to back it up because I'm too lazy to do that shit anyway, but almost everyone I remember didn't come to an end until they come out. And think of it, logically, like, this is money that is thinking long term in a sense, right? They're willing to wait out the rough periods. And when they finally give up, right? That's true capitulation, isn't it? Isn't that true capitulation? Right? The problem with making the argument for capitulation now that I have is that I turn on CNBC and I hear the words generational buying opportunity at least 10 times a day, minimum. Because every so-called guru they bring on, and they ask them, is this a bottom? Are we at, do we hit the low? And here's their answer all the time. Well, nobody can call lows, but I can tell you this: if you have a year, 2 years, 3 years, you'll be more than happy with this entry. Every effing guy that comes on there says the same exact thing. They take the easy way out and they say, as long as you hold through the weakness from here, you'll be okay. And I promise you that every major bottom I've been a part of, that's not how they feel. That's not how they feel. You know what I mean? It gets that feeling. It shake it out of their hearts and heads. They felt like that from the 2000 top all the way down to literally, I think it was 2002. For 2 years, they felt like all you got to do is wait it out, and they rode that shit all the way down, and then they finally spit it up. Great call. That's another great Hartnett piece that he wrote up, right? This drives the point home, and we don't have to talk about this anymore. $100, you ready? For every $100 of inflows to funds that came in to the market. Okay. How much has come out of equities? Okay. And let me give you this, just so you get an idea. Market bottoms, minimum $40 of that 100 comes out, minimum of equities, minimum. Okay. I think one of them was $60. It might have been 2008, but $40. You ready for this? No, it went down $1, Sal. It went down $1. They put $1 back in. They put $1 back in. So you know what I mean? Like, you see that capitulation, the word gets thrown around too loosely. I would love to say there's capitulation too. I mean, I would love to say it, but you can't make the argument that there's been capitulation in equities. There's been capitulation, I think, in the REITs, in the REIT market, bonds. Several bonds had capitulation. I forgot what we went over the couple of things that had some capitulation. But you can't make the argument that $3 out of 100 came out of financials. Good call. That $3 came out of the 100 equities as a whole, and you got capitulation. You can't make that argument. You can't. You can't. Does it mean we can't put in a low and rally till February? No, it has got nothing to do with that. It's got nothing to do with that. You're just not going to get that V-shaped recovery to new highs, set off a whole new bull market, history says. like the only thing that would possibly offset this where you don't like you don't want to pay too close attention to it is if you get the Fed start rigging the game in your favor again, right? Because then again, you ignore a lot of this stuff, don't you? Right? The same thing's going on, just the opposite right now. Right? When the Fed is pumping money into the system, the more you look at, the more of a waste of time it is. Right? Like think about all the riffraff out there. If you ask them, well, how much is QuantumScape? How much does QuantumScape do in revenue? They would have slapped you in the face a year ago. Revenue? What the fuck? What do you ask me? How much does QuantumScape do in revenue? Their answer would have been, by time I go do some research and figure out what they do in revenue, the stock might double tomorrow. All that meant nothing. By the way, they do zero in revenue. I highlighted today, literally zero. Okay? QS, zero in revenue. The guidance for the quarter is a solid zero. How do they miss? Somebody tell me how they miss their guidance this quarter. Is it possible? Their estimates are for zero revenue. So anyway, all that stuff didn't matter. You know what I mean? Of course it matters, but when the Fed is pumping money into the system, who cares? Right? Money's got to find a home. Money sloshing around all over the place. So, but see, now it's the opposite. It's literally the opposite right now. You understand? They're sucking the money out of the system. So money doesn't find a home, money leaves homes. They run away from their houses right now. So it's a little pickle we're in right here. No, all kidding aside, it's not it's not an enjoyable scenario here for bulls. Another part of the financials. God, I'm tongue tied. 4 o'clock, guys. You got to forgive me. After the bell, forget it. I can't even think straight. Another ingredient to the Fed rigging the game, tightening financial conditions. Right? It's a part of it. Like you have the dollar strengthening. What do you think is gonna? If this continues, this is a debacle. I don't think you guys realize this is a debacle, capital D, debacle. The dollar ripping like this. You're going to have countries go bankrupt. Yeah, and you're talking about major, companies here that are going to have issues. But more importantly, you're going to have countries, emerging markets that are going to be in shambles. Yeah, exactly. They can't handle this. Like, listen, you talk about dollar strength, it's one thing. I'm no currency guy. This is beyond dollar strength here. This looks like QuantumScape. Look at this. Right? This is a rip. Now, when you get this, right, you see how that could be beneficial. But this is not no choppy uptrend. This is a ripper. This is a ripper. So again, I don't want to get too macro. This is when we're in a normal environment, you're never going to hear me talk about this stuff, guys. We're going to talk about what's the top sweeper activity today? What growth names, any new growth names, what are they buying? What's at a good spot for an entry? Like those are the things we talk about when the environment is favorable. You want to survive this type of environment. These are a lot of the things you don't have to stare at them, but you have to pay attention to them because they get in the way. They get in the way constantly. They constantly get in the way. Like for example, just this, which is a measure of financial conditions tightening, that IEF LQD ratio chart we look at, right? Like, besides that, there was no call sweeper activity because of earnings and all that, and the majority of flow was put. Besides that, Okay. When you saw this, why does this chart look so weird? When you saw this pop like this early on, you know, how the hell are equities going to go higher into that? It's not an easy thing to do. It's nearly impossible. You know, you get algos just selling equities off of financial conditions tightening just on itself. You know, and same thing. Doesn't mean when it's not higher, the market has to rally. But if you're looking for a low, I mean, if you're looking for an entry, you have a better shot of making money if financial conditions aren't aggressively tightening at that moment. You know, so same thing here, right? This came down, equities rallied. This has come up the past couple of days. What a coinky dink. Equities have sold off. So it helps. It helps, but it still doesn't make things a lot easier. I'm not one of those guys. Trust me. It's a tough game right now. Don't let anybody fool you. Tough, really tough. Anybody have any questions? Usually we look at some of the sentiment stuff. Here's the thing we usually look at, right? So it's this simple, guys. There's nothing to pay attention to. You see this? This is all here already. The only thing that's not there is that fund flow that we just went over. That's the missing link. All right. And then you'll have everything on buy signal. So that's that. That's why there's nothing really to talk about there. Here is an average of all those indicators where it's at. This is out of Goldman, by the way. This is also contrarian bullish. See that? So money flowing into safer assets than risk-on assets. Literally, guys, literally, it was maybe a month ago, a little more than that. Money was flowing into riskier assets more than safe assets. Might have been a little more than a month ago, but anyway, not too far, not too long ago. You see it here. Markets don't bottom like that. Look at, here's COVID. Here's late 2018. Right? Those are two major bottoms, right? So now you have this here. This has put in lows, 2015, 2016. You could go back and look at years where, those were corrections though. We got a different animal here. But anybody have any questions? To ignite a buying spree, but where? Where's it going? Where's it going? That's the question. Where's it going? You see how easy it is? We just went over it to forget this stuff. If, like I told you, if the Fed wasn't rigging the game, I'd be all over this. I'd be all over this because I'd be thinking the same thing. As soon as that match gets lit, this thing's going to fly. We might have seen where this thing goes. And this is it. You understand? The Fed won't allow this. Right. That's the difference. The Fed can't allow that. It can't. Think about what the Fed's trying to do here. Can you imagine if risk assets light up and the bear market comes to an end and this market rallies like a banshee? Bitcoin comes roaring back. People buying jarred farts and canned sweat like nothing ever happened. Fed's not, we're too far gone. Fed's not allowing that. So you want a better idea of where we are? Oh, Hani taught me 10 times. I still can't do it. Huh? Where'd it go? Hold on. This is kind of your measuring stick. Oh. What? What the? Oh. Okay. These. You want to know something funny? Positioning was like that. The same type of positioning we have here was like that here and was like that here. Okay. And it resulted in this. That's a good measuring stick. You get more than that, that's great, but I wouldn't plan for it. You know, again, unless the Fed somehow stops rigging the game, right? I don't know. I can't say it's not possible. I don't know. Powell, who knows? You know what I mean? The guy could be high on ecstasy one day, tripping, and come in to a Fed meeting and feel great and say, listen, guys, I'm done. You know, I don't know. It's not good odds, but it's possible. But this, you know what I mean? This, that's usually when the Fed is all in and fund flow puked. Okay, because let me give you an idea, right? Pretend we're right here. Okay, we get through earnings, doesn't look like much. You know what? I'm gonna do it better. I'm gonna put you in the moment. I love to do this to myself. It's torture, but I love it. I'm gonna put us in the moment. Hold on. What moment am I? Okay. Here's the moment I'm putting us in, even though we could be over here somewhere, but let's just put ourselves in the moment here, okay? Here it is. Sharpies get long, everybody's short, positioning is lopsided, okay? We should squeeze. We do. Nice squeeze, okay? Look it. All right, now what? By this point here, right? We got through earnings, Apple beat, Microsoft survived, Google survived, commodities rolled over, the economy, the wheels are starting to come off, the Fed's getting close to stopping, right? That's going to be the lingo. The Fed's getting closer to that pivot. That's over here. Whoa, boy. New highs, baby. What? Any new SPACs? Lulu, bring me a new SPAC. I'm ready. Right? That's what we're feeling right here. They couldn't sell it. Yeah, Shama tweeting it out. Look. Okay, didn't look like much when we blew it out, right? When we big picture. Okay, now, wrong Zoom. Oh. What? I got to go further back in time? What an idiot I am. When are you guys going to tell me that? Torture, I swear. All right, so here we are. Feels a little different, okay? But anyway, this is what now? March, April, May. Okay, 2 months. 2 months. Downtown Josh Brown, we're making higher lows, he just said on the halftime show. Exactly. Uptrend, baby. Okay. Now, at this point, by the way, all that positioning we just looked at that was net short and lopsided, you think they're still like that here? Okay. At least they've covered shorts, and likely the reason why we've been doing this, right? Okay, you see every little dip looks like short covering right back. Look at this. Look at this. We're all bulled up. Oh boy. We're all bulled up. Don't lose faith. Oh boy. They're going to buy. Oh boy. Oh God. Double bottom. Double bottom. Don't worry. Look at this torture. Look at this torture, guys. These are days. These aren't minutes. These are neither. These are days. Oh, it's torturing me right now. Triple bottom. Oh shit. Bunker. Where's my bunker? Get me my fucking bunker, right? This is getting the bunker now. I'm in the bunker officially. You're not in the bunker? Look where we are. You know what this feels like? Okay. Do you know what this feels like after this higher lows that Matt was calling at from Josh Brown? Do you know what this feels like over here now? Waterfall? That's a waterfall. Oh my God. All right. So there you have it. There you have it. There you have it. Jesus Christ. Your first year was 08? Jesus, mine was 98, which was pretty vicious, but 08's a crazy first year. 08's a crazy first year. But yeah. So the point I'm trying to make, guys, is like right now with the evidence in front of us, you think about it, the only thing, like Harnett said, it's so bearish that it's bullish right now. That's just based on positioning. So what's likely to happen is something like this to level out some of that positioning. You know what I mean? That's what usually happens. And then honestly, we don't even have to get to trying to plan out this far. Let's see how things look, at that point. You know what I mean? Like, who knows? Maybe fund flows capitulate here. Who knows? Maybe they leg into shorts instead of taking off that short exposure. Maybe they're committed. You don't know how it's going to play out. Maybe the Fed pivots because the economy is, something shatters. That's what's impossible about right now. How do you forecast that? You know what I mean? How can you plan for that? You can't plan for that. You know what 2 months are when the Fed's doing what they're doing right now? It's an eternity. You know what can happen in 2 months? All right. Bayes knows his first year was 08. You saw Merrill go under Bear Stearns go under in a month. You know what I mean? There's so many things that could happen, especially when the Fed's doing what they're doing. So, but that's what to answer your question, that's what I would that's what I would look for. And as far as opportunities are concerned, now the way things are lined up, right? There's dips. They should hold things together here. They should hold things together here, the way the money's positioned. The risk to that would be something freezes or breaks. Because, that's what happened here. You understand? It didn't matter who was short, right? It didn't matter that every hedge fund was short, because everything blew up. You understand what I'm saying? It wasn't just the equity market. Commercial real estate blew up. Residential real estate blew up. The credit system blew up. Everything that exists in the economy blew up. So, nothing applies. That's all out liquidation. All out liquidation. So that's the risk. You get into something like that, and then the positioning we're looking at, hedge funds a little short, doesn't mean a damn thing. But there's nothing broken yet. There's nothing broken yet. I don't care what anybody says. There's nothing. The Fed didn't break anything yet. What'd they break? Yet is the key word, exactly. It's stupid to even give them credit, but the way this has played out to this point, you can't knock them. I'm sorry, you can't knock them. You can't knock them for as big as a mistake as they made, being so late to tackling inflation, and it's resulted in this so far. I mean, if you would have told me this last year, that the Fed was going to rig the game, raise rates aggressively, drain liquidity, money supply was going to go negative. I mean, if you told me all this was going to happen last year, I would have told you Dow 1,000. No? Honestly. A lot of us, including myself, thought that they tried to raise rate once, right? And the market would throw a little tantrum, and that's it, right? You don't remember those conversations? Like, and listen, inflation, I get it. That's the difference. It's inflation. That's the difference. Honestly, if inflation's not here, the Fed already pivoted. It doesn't even get to this point. No, they're not raising rates or a QT into this. If there's no inflation, we'd be QE 5. What are we up to, 5? If there was no inflation. That's the difference. That's the difference. The only difference. The only difference. So yeah, just a quick wrap on it. That's what I would look for, right? So again, just simple terms. You look for a potential floor here, right? If everything stays the same, potential floor. So you want to look towards weakness and look for opportunities. There should be better. In other words, you could probably find more alpha in individual names. The problem is you got to sidestep earnings here, but there are going to be, like we see it already. You see, I mean, Apple. Look at Apple the past couple of weeks. So that's the point I'm trying to make. Like, you'll get a smoother ride in certain names as opposed to just the indices, right? The indexes could chop around and names could go higher. So as we come out of the heart of earnings, I think that's going to be a good thing. You know what I mean? I think that's going to be a good thing. We could look. I can't remember like individual names. I'll be honest with you. The names, like I can't even play individual names. There hasn't been any edge there. You know what I played the last couple of days? You guys are going to laugh. This is what it's come down to. You guys probably know me better than myself anyway. What name do you think I played a couple of times over the last week? There's one name I played. Yeah. Siga. Exactly. You guys probably played it too. That's why. You know what I mean? Because like there's no edge anywhere else. What am I going to play? What am I going to, again, just an example, play Amazon, a couple call sweeps, and then there's a couple put sweeps 5 minutes later because of earnings. You know what I mean? So like, this is not earnings positioning. It's all hype off the monkey flu or whatever the fuck it's called. So and then there's been some clean action there. I mean, what am I going to do? But, even if we're in a rough market, No, I didn't hold it. Is it up after hours? Why, you're holding on to a piece? I don't blame you one bit if you are, by the way. I don't blame you one bit. Yeah, it's worth a little piece. I mean, this has got nothing to do with anything. It's all monkeypox news driven. Like supposedly this is the one drug, right? The one, whatever it is. Like this is the only play on it. There's another name that's going for approval or something, a treatment. I don't know. It might be bulletin board for all I know. But anyway, that's what the example I was giving is like, those, we might get a little of that back in action again. Like they're sweeping a particular name. It's got nothing to do with the macro. It's got nothing to do with the market. There's just some excitement in the name and we could get a play out of it. Intraday, swing it for a couple of days, whatever it may be. No, this stuff, honestly, X, the stuff that, I mean, the majority of my long-term stuff has been tied up in funds and shit like that. I never touch it. Never. I never look to touch it. Because the problem with that stuff, I'll never get back in. So I concern myself more with looking to add to that stuff when I'm ready. Yeah. And then I got a couple names. I actually moved the names into my daughter's account that I have for her, so I don't touch them, Otherwise, I'd be flipping that account left and right too. No snap. I told you, I'm looking forward to the time. It feels like an eternity away. But when new growth names, new leaders, it'll come. It'll be worth it. It takes patience, man. It takes patience. This is part of the market, But yeah, so in the meantime, we deal the hand, right? We play with the hand we're dealt. And, right now we got to be smart, got to be picky. Even on an intraday basis, you miss a rally, what's the big deal? Spit on it, you'll get another opportunity in a couple of days, if that, in this type of market. Be picky, be selective. Exactly. Save your ammo. I told you, if you can get through this time, break even, you're a hero. You make a little bit of money, even better. You have some bullets to fire. Again, even if we don't hit a major bottom, there'll be a better time, especially in individual names. But right now it's just up till now, until just recently, you got high correlation out there. Everything moves with the macro, with the indexes. Everything is the same. There's no difference. You know what I mean? What we're going to start to see is that names act different. The market is down. Doesn't mean every stock is going to be down. We're not used to that. But that's the way the market works. You don't need the market to be up every time for your stock to be up. The market's down some, and you can have a stock that outperforms. No doubt about it. Go ahead, Lourdes. I'll see you mañana. I'm going to wrap it up now anyway. Anybody have any last questions before we wrap it up? All right, but I think, like I said, we get through next week, I think we'll have more opportunities in the individual names to play around with. And that'll keep us occupied and make some money. But in the meantime, let's see what goes down tomorrow. We got a big Fed day tomorrow. Should be really interesting. I appreciate it, guys. Jay, everybody. X, good seeing you. Enjoy the night. Good luck mañana. Buckle up. Later, guys.